Hi, so I've invested into Facebook as one of my core holdings, and today I'm going to see if there's an opportunity in the other social media platform, Twitter. And the reason I want to dive a little deeper is because one of my favorite investors, Guy Spear, has just invested in Twitter. Now, granted, he only bought a small allocation of the company, and it actually put it on my radar in the first place. So let's go see if we can work out why. If you're new to my channel, well, welcome. My videos are about investments that anyone in the world can make. And what I'm trying to do is help other investors understand the basics of investing, especially in the stock market. There is so much noise out there, and a lot of people put more research into buying their next computer or their telephone than they do in the investments they make in the stock market. Now, I'm 32 years old and I have about $600,000 invested into the stock market, and I'm trying to grow that at around about 20% per year. Now, I'm not perfect at this. Not every investment that I make is going to be a home run. I am always learning, and I think the best way to learn is to teach. So here I am showing you how to analyze the company. All right, now let's get into Twitter. And Twitter has actually had quite a wild ride on the stock market. Now, Twitter completed its initial public offering in November 2013 at $26 per share. And the shares rose quickly to nearly $70 a share. Before then, weakening user metrics and sharply slowing revenue growth caused management turnover and investor despair, taking the shares down approximately 80% from those highs. Now, recently, the stock fell actually over 20% in one day because of their latest earnings report. So this isn't some stable, boring stock. It is volatile and it will test your stomach. Look, pretty much like any stock, you don't really want to watch this one too closely. Now, in my opinion, I think Twitter do have quite a substantial moat. See, a lot of their active daily users are using Twitter and they rely on Twitter for their work. So the company's platform is essential for those in the media, politics, sports, entertainment, and investment industries, and for all of those who are interested in current events. There is no other source for truly real-time news and unfiltered information. When world events occur, well, the news and first-hand photography and videos, well, it's going to break on Twitter first, far before the traditional news gets to it. Now, I also think that Twitter is a little bit under-monetized, and there's a lot of opportunity for them to grow their revenue. They could incorporate some sort of premium account feature where you don't see any ads, or they could just improve their ad infrastructure that they currently have. If they can do something even half as good as Facebook, well, they're going to make a lot of money. So the big reason the company hasn't quite followed in the footsteps of Facebook and Instagram is because the growth has really plateaued. This is the monthly active users growth up to about the start of 2019, and it has definitely matured from a growth rate point of view. Now, this is the daily active users, and over the past few quarters, as you can see, it has actually started to grow again. It is slow growth, but it's still growth nonetheless. It's definitely not dying or anything like that. So I think the main risks with this investment is whether the company can successfully monetize their users without their users starting to hate the service. If they get this wrong and the ads are too intrusive or there's just too many of them, well, daily active users are going to go down because people are going to leave. So this is one of my favorite super investors, and his name is Guy Spear, and he runs the Aquamarine Capital Fund. He is a true value investor, and I have a lot of respect for his style of investing. So when I see a company that he has invested in, well, I take notice, and that's exactly why we're looking at Twitter today. Now, this is Guy Spear's 13F document showing exactly what's inside his portfolio. So now, Twitter is his smallest holding and it's the newest one as well, and he bought it at around about $30 a share. It looks as though this is a bit of a let's see what happens kind of investment. When you have hundreds of millions of dollars, you can do things like this, I guess. Now, I think there's actually nothing wrong with copying the great investors. They have far more experience and they've made far more money than any of us are probably ever going to make, so copying them is fine. I actually think it's a great investing strategy. Just get the great investors of the world, get their 13F documents and copy exactly what they buy and sell what they sell. It's probably one of the most underrated strategies out there, and it's something that I'm going to be doing a lot more of. So here's the latest earnings information coming out of Twitter for Q3. So we've got revenue up to $936 million. Now, analysts thought it was only going to be $777 million. The earnings per share was 19 cents per share. Analysts thought it was going to be 14 cents a share. And there was 187 million active daily users. Now, the analysts thought it was going to be 195 million. So that's the only miss they have here. And that miss in the daily active users is why the share price drops so dramatically. Look, this is just short-term noise in my opinion. Analysts are taking estimated guesses. The longer-term trend is what is important, not what happens quarter by quarter. So maybe this is an opportunity to get a better price. We need to go check their finances first though. With any business, to check their financial strength, we want to look at these three areas. Can they handle their debt? Are they growing? And are they a well-managed company? Now, don't worry about the terminology here. Just sit back and relax and just try to get a feel for what's going on here. It's really important to look at the company's debt because a business will have a really difficult time going bankrupt if they don't have any debt. Unmanageable debt is the number one reason that companies get into trouble. So to see if the business can handle its debt, what I'm looking for is the debt to equity ratio and the current ratio. So Twitter's debt to equity ratio at the moment is a 0.4, and I'm looking to see this under a 0.7, so that's good. And their current ratio is above 4. I actually only want to see this above a 1.5, so there's nothing to be worried about here regarding debt, so let's move on. So in the finances, to check for growth, I'm looking at the book value per share, the earnings per share, the operating cash, and their gross margins. Sure, 2020 is going to be a bit of an exceptional year, so I want to think about that when I'm looking at these charts. So this is their book value per share and solid growth here for Twitter. The overall trend is what is important here. Now this is the earnings per share, and 2019 was showing good signs of this earnings per share turning and staying positive, but unfortunately it hasn't happened in 2020. Now this is the cash generated from operating activities, and it follows a similar pattern to the earnings per share. And lastly, we're going to look at the gross margins, and it's something I've started to focus a lot more on lately. See, a company that can grow their gross margins is doing a lot of things right. And as you can see, well, Twitter have great gross margins, over 60%. This will serve them very well. I think I can only give them a half mark here because that earnings per share was very inconsistent. Even though we saw daily active users were starting to grow again, maybe that's pandemic related, so I'm just not quite sure about their growth. Now, we can't just call up the management team on Twitter and ask them whatever questions we want. But fortunately, there are some telltale signs in the financials that will give us indications of whether the management are making some good decisions. So what I'm going to check for is the return on equity, the free cash flow, and their cash on hand. Now, I want to see their return on tangible equity above a 15 on a yearly basis. And in 2019, it was above this 15, which was great, but it has dropped back down again. So it's a little bit hard to trust. This is the cash in the bank, and as you can see, it's been growing, so that's good. Now, this is the company's free cash flow, and unfortunately, there's more signs of weakness here in 2020. So overall, the finances don't give me much confidence that this is going to be a good long-term investment. But I like that they have very little debt. Their user base is starting to grow this year, and maybe they can monetize really successfully, and this could be a big winner. So let's go see if it's at a really attractive price, and maybe it is a really good investment because of that price. Now, to get a copy of the calculator that I'm about to use to help you find intrinsic value, well, it's free and it's in the description below. Now, when I say intrinsic value, what I'm talking about is based on the growth rates of the company and how much money the company is making. Well, intrinsic value is the correct current share price. Now, it's definitely not perfect because we're making assumptions of the growth rates of the future, but it helps us get a bit of a ballpark figure. Now, of course, the stock market often overvalues or undervalues companies, so this is just one good approach to working out value. So here's the data inputs that I got to calculate the intrinsic value of Twitter. Now, the growth rate from years 1 to 5, this was really difficult because I had Yahoo Finance telling me it's going to grow at negative 18% per year, and then you had Zacks, the Zacks website, estimating that it's going to grow at positive 38%. That is just a ridiculous discrepancy. So I think we definitely need to play around with the numbers here. Maybe try a positive scenario and a negative scenario. So the one I've got here first is obviously the positive scenario where we've got a growth rate of 38% and the growth rate from years 6 to 10 dropping back down to about 20% as it matures. And the buy price, this is actually not a buy price, this is intrinsic value at the moment because we've got a discount rate of only 8.5%. This is not a buy price. This is what would be fair value right now. It should be about $64, $65. Now let's use the growth rates for the really negative case scenario. Okay, so now what I've done is I've put in negative 18% as the growth rate for the next 5 years and then going up to 0% for years 6 to 10. And it tells us that the current intrinsic value should only be about $5, $6. That is a huge difference. So using that 38% growth rate, it came to about $64 with no margin of safety. So a solid buy price, if we think that growth rate is going to be 38%, is about $32, and that would give us a decent margin of safety. Now, using that negative 18% growth rate, well, the fair value is only $5 with no margin of safety, and therefore a buy price would be about $2.50. That's going to be crazy. So remember, this is just my estimates. Play around with different growth rates. If you think things will be better than what I think and what the analysts think, then try higher growth rates. Just don't forget some margin of safety because no one is going to be able to predict exactly what's going to happen in the future. So you definitely need some breathing room for errors. Now, I'm looking at this in November 2020, and the current share price is $43 for Twitter. So even with those crazy high growth rates of 38%, the price to buy would be in the low 30s. So clearly, at the moment, this is not a bargain by any measure. Maybe under $30 and it would start to get a little interesting, but I would want to see if the monetization strategies are still going to be working. Now remember, Guy Spear bought it at about $30, so that is where he thought it was worth buying. So that's something to remember. So I think I do understand why Guy Spear has invested in Twitter. Maybe they can monetize beautifully, and maybe they can use the cash that they have in the bank to fuel exponential growth into the future. So if that scenario does play out, well, the stock price could grow and grow and grow and grow. Now, I think it is a bit of a gamble, but I do see how it could be asymmetric risk, which means the upside is far higher than the downside. So do I want to invest in Twitter? So if you don't mind a bit of volatility, well, maybe Twitter is for you. But I'm happy to take a pass here because I think there are other options where we could invest in companies that the upside, well, it's more likely. Now, definitely let me know what you think of Twitter as an investment because I'd love to hear everyone's opinions. Thanks for staying right to the end of this video. Hit subscribe if you want to see my future videos, and I will see you next time.